Banks want us to believe that our money grows while sitting in our accounts. They show us increasing numbers due to the interest, but in reality, the value of our money doesn't grow at the same pace, especially when inflation is surging. The interest rates offered by banks are usually not enough to keep up with rising prices, which means keeping money in the bank can actually lead to a loss of purchasing power. In this video, I will reveal 6 different assets that can protect your wealth from eroding and assist you in building lasting wealth that can benefit future generations. If you're new to here, which most of you are, please subscribe to my channel and turn on notifications so that anytime I post videos like this, you are the first to see them. Number 1. Industrial commodities. Precious metals like gold and silver are valuable due to their scarcity and practical uses in electronics, medical equipment, and nuclear reactors. Other metals like cobalt, nickel, and copper are also in high demand for their unique properties, which other materials can't easily replicate. The demand for cobalt has surged since 2020 because it's essential to making batteries for EVs. Its price has since doubled, from $20,000 per ton in 2012 to $40,000 in 2023. Investing in such raw materials can be profitable during periods of high demand. However, it may not be feasible for everyone to buy and store them physically. Instead, you can gain exposure to these commodities by investing in stocks of mining companies like Rio Tinto, mining-focused mutual funds, or using financial derivatives like futures and options. These investment options allow you to benefit from the potential growth in the industrial commodities market without the need for large upfront investments or physical ownership. Number 2. Value stocks. While treasury investments are safer than cash and provide better returns, they still offer lower returns compared to stocks. For investors who are risk-averse, the low risk of treasury investments is crucial. However, most investors seek higher returns, and that's where stocks come into play. Not all stocks carry the same level of risk. The stock market can be broadly divided into 2 types: value stocks and growth stocks. Growth stocks, like those in the technology sector, are riskier because they deal with innovative ideas and technologies that might not always succeed. On the other hand, value stocks such as Nucor, which deals in industrial metals, are considered less risky because there is a consistent demand for such commodities in the foreseeable future. Value stocks with strong fundamentals not only offer steady and stable price appreciation, but also provide stable dividends. This can be attractive to investors seeking reliable returns. However, conducting research on the fundamentals of each value stock can be time-consuming and challenging for average investors. To make the investment process easier, dividend-focused mutual funds like the Vanguard High Dividend Yield Index Fund Admiral shares come into play. These funds have a stable history of paying dividends and are ideal and affordable investment options for retail investors. Number 3. Land and real estate. Land and real estate hold significant value for a good reason, according to accountants. Land is considered a valuable asset because it's scarce and always in demand. Throughout history, it has been a crucial resource for various purposes like homes, schools, factories, agriculture, and businesses. With the world's population growing, the demand for land will only increase. The properties built on land, such as residential homes, offices, and commercial spaces, are also consistently in demand. This makes both land and real estate excellent investments to protect against inflation in your portfolio. For instance, housing prices have tripled from 1992 to 2020, even with a dip during the 2008 housing bubble, as reported by Bloomberg. Despite these benefits, many small investors tend to consider real estate investment only much later in life, often thinking solely about the house they live in. However, it's advisable to have exposure to the retail property market at any age. You don't necessarily need a lot of money to get into real estate. There are options like REITs, real estate investment trusts, that function like mutual funds but for real estate. For example, Ventas Incorporated is a well-known REIT in the US, investing in healthcare real estate, including senior housing, research facilities, and hospitals. Moreover, you can consider borrowing to own rental properties, where the rental income will cover expenses and mortgage payments while generating profits for you. It's an approach that can be financially viable and offer opportunities for wealth accumulation. Thank you for watching this video to this point. We appreciate the effort. Kindly like and subscribe if you haven't done so. Number 4. Collectibles. Collectibles encompass a wide range of valuable items, such as vintage cars, rare artworks, handcrafted luxury handbags, limited edition watches, and iconic first edition books. Unlike regular cars that lose value when driven, vintage cars tend to become more valuable over time, just like fine wine. For example, a 1955 Mercedes-Benz 300 SLR Uhlenhaut Coupe was sold for a staggering 135 million euros in 2022. Only 2 of these cars exist, making them highly sought-after collectibles among car enthusiasts. Similarly, in 2017, a controversial painting by Leonardo da Vinci called Salvator Mundi was sold for a massive $450 million at a Christie's auction to a Saudi prince. The rich are willing to spend large amounts on limited edition items because they see them as timeless treasures that hold and increase their value. Finding the right buyer for these unique pieces can result in exceptionally high prices. However, for average investors, owning collectibles might seem like an unreachable goal. Luckily, there are online marketplaces like Whatnot where you can sell rare baseball cards, comic books, action figures, and more. Additionally, platforms like Convoy and Masterworks offer opportunities to invest in partial ownership of collectibles, making it more accessible to a wider range of investors. Number 5. Divine currency. Gold, silver, and platinum. One of the main reasons why money is considered valuable is because it helps us store value for the future. However, nowadays governments keep printing more money to cover their deficits. As a result, the paper currency you know as the dollar might lose its worth over time. That's why financial experts suggest investing in something valuable that is limited in supply and not easily created. This is why wealthy individuals always set aside a portion of their investments for precious metals. Precious metals like gold, silver, and platinum tend to increase in value when inflation rises rapidly. Back in the 1950s, you could buy an ounce of gold for only $400, but in 2023, that same ounce cost over $2,000. According to Prime XBT's gold forecast, it's predicted to reach $10,000 by 2032, which means your gold investments could be 5 times more valuable in about 10 years. So, while the value of cash keeps decreasing, the value of gold keeps rising. Likewise, other precious metals also outperform keeping your money in a bank. If you're wondering how to include gold in your investment portfolio without purchasing physical gold, you can consider investing in gold ETFs. Gold ETFs are affordable investment options that provide returns based on the movement of gold prices, without the need to physically own the gold yourself. Safe haven currencies. In today's world of fiat currencies, where no currency is backed by gold, it's essential to consider geopolitical stability when investing your money. That's why wealthy individuals often choose to keep their money in Swiss banks. Switzerland boasts one of the strongest economic systems globally, offering a more stable geopolitical environment. Because of this, the Swiss franc is seen as a safe haven asset during times of turmoil and uncertainty. We witnessed this in various instances, like during the Eurozone debt crisis in 2009 and the global financial crisis in 2008, when significant funds moved to Switzerland to protect wealth from currency depreciation. The Swiss franc is also a valuable option for international trade, especially as an alternative to the US dollar. For example, during the recent Russia-Ukraine crisis, when the US imposed sanctions on Russian energy trade, Russia conducted trades using the Swiss franc. This high demand for the Swiss franc led to its remarkable appreciation against other currencies. In the early 2023, one Swiss franc was worth $1.10 US, resulting in substantial wealth gains for Swiss franc holders almost overnight. In addition to the Swiss franc, other superior currencies like the British pound and Chinese yuan are also considered excellent stores of value. However, since not everyone can open Swiss bank accounts, there are alternatives such as currency ETFs and forex brokers like forex.com. These options allow smaller investors to gain exposure to different currencies with as little as $100. Number 6. Sovereign guarantee. Have you ever noticed the words on a dollar bill that says, "This note is legal tender for all debts, public and private"? It means that since 1971, when the gold standard was abolished by President Nixon, the US dollar became the official currency according to the law. This gave it value as a way to exchange goods and services. Although no fiat currency in the world is backed by physical assets like gold, they are still considered to have value because they rely on the trust and confidence people have in their government. In simpler terms, the stability of your money depends on the strength of the government supporting it. This is why investing in a sovereign guarantee can be a smart way to preserve value. Governments are generally very unlikely to default on their debts because if they do, it can lead to a crisis for the whole country, and no responsible government would want that. So, investing in government securities or G-SECs is one of the safest ways to go about it. However, it's crucial to choose stable governments with good credit ratings. For example, let's remember the 2009 sovereign debt crisis in Greece, where the IMF, Eurogroup, and ECB had to step in multiple times to rescue the country from its debt troubles. That's why it's important to consider a government's overall strength when investing in G-SECs. In the United States, you can invest in treasury bills, notes, and bonds to gain exposure to sovereign guarantee. These options often offer better returns compared to keeping money in the bank, and they are backed by the strength of the US government and the global economy. If you're a small investor, you can buy treasury securities directly from the government through the Treasury Direct portal or from the secondary market. That is all for today's video. If you found this video helpful, make sure to leave a like and subscribe to the channel so that you get notified when we make more personal finance videos. See you at the next one.